In this episode, you're going to learn what to do when a company reduces or eliminates their dividend. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover 4 topics. We're going to start off with 2 definitions. What is a dividend? What is the dividend yield? Then we're going to look at how a dividend cut will impact you. We're going to look at an early warning sign of when a dividend reduction might occur, so you can make different decisions at that time. And then what to do after a dividend has been either reduced or eliminated. Let's get started with our 2 definitions first. Coca-Cola has a little over 4.3 billion shares outstanding. If you were to buy all of the shares, you would own the entire company. But if you were to buy just 5 shares or 100 shares, you would still be considered part owner of the company. And as part owner of the company, you are entitled to share in the profits of the company. And those profits come to you in the form of dividends. So let's say a company is giving a dividend of $1 per share, and you own 1,000 shares. You will receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. The dividend is deposited directly into your stock trading account. You can spend the money if you wish or reinvest it. It's entirely up to you. So what is the dividend yield? That is simply the annual dividend divided by the share price. So let's take a look at an example here. So let's say a company is paying a dividend of $1 per share. That's the annual dividend. And you were to buy the shares today at $20 a piece. So 1 over 20 expressed as a percentage is 5%. So in this example, Jill, who's the shareholder of this company, wants to invest $20,000. She's thinking about investing $20,000 in this company. And the share price happens to be $20. So 5% of $20,000 is $1,000. So she will earn $1,000 in dividends every single year, as long as she continues to own the shares and as long as the company continues to pay the dividend of $1. Now, it's important to note here, this is regardless of the stock price. If she's bought the shares today at $20 and the dividend is $1, her yield is going to be 5%. The stock price can go up to $20, $30, $40, $50 a share. It can go down to $5 or $10, $2 a share. It doesn't matter. Her dividend yield based on her purchase price will be 5%. And the dividend yield, again, like I just said, is based on your stock purchase price. So basically, the dividend yield is the return on your investment while you hold on to your shares. Again, regardless of what happens with the stock price. So how does a dividend cut impact you? So let's take a look at this. We're going to stick with the same example. So the dividend is $1 per share. The share price is $20. You can see on the screen, the dividend yield is 5%. Now, what happens if the company cuts the dividend from $1 a share to 8 cents a share? What is going to happen to the dividend yield? And you can see that on the screen. The dividend yield is then going to be 0.4%. Right? How do we get that? We take the dividend, the new dividend, which is 8 cents, divided by the share price, which is 20, and we express it as a percentage, and you can see it's 0.4%. Now, if the company cuts the dividend completely to 0, well, then your dividend yield is going to be 0%. So as a dividend investor, this is a huge impact on your investment. A dividend reduction is going to reduce your dividend yield. So now let's see what this looks like in real life. We're going to look at an example here with Six Flags. So if you had bought 225 shares back in 2014, and the share price at the time was $42.55, your total investment in Six Flags would have been $9,573. Now you can see here the dividend at the time was $1.93, And the following year, the company increased the dividend. Then they increased it again, and the dividend kept going up. Except, look at what happened in 2020. The company reduced their dividend to 25 cents a share. And when the dividend gets reduced, what happens to the yield? You can see it up on the screen. Now we take 25 cents, which is the new dividend, divided by the purchase price, which is $42.55. And you can see that the yield has gone from 4% to 0.59%. So you're getting a lot less in dividends. And then the story gets worse because in 2021 and in 2022, the company eliminated the dividend altogether. And when that happens, your dividend yield is zero. You're not going to get any more dividends. So you can see here, the initial investment was $9,573. Today, it's only worth $8,174. The stock price has gone down 51% since 2014. Now, the good news is that you've had some dividends since 2014, and so those dividends had allowed your losses to be less. So, still not good news though, but you're still looking at a loss of 14%, but definitely a lot better than 51%. So the dividends provided a little bit of a cushion there, but you can see the impact of the dividend cuts, right? A dividend reduction is going to reduce your dividend yield. There's one more impact of dividend cuts, and that happens to affect the stock price. So we saw that with Six Flags. I just showed it to you. The stock price has gone down 51%. But let's see what that looks like with another example. Now we're going to look at Boeing. And this is the stock price over the last couple of years for Boeing. And can you see that? I'm going to move the mouse here. So for those of you watching the video, can you see the drastic drop in the stock price in 2020? Right there. And what happened there? The company announced a dividend cut, eliminating their dividend altogether. And you can see that the stock price was up here and huge drop in the stock price. And it still, to this day, has not recovered to where it was. It's even high of 2019 or even in 2020. So the stock price has not recovered. So why did the stock price drop after the company announced a dividend cut completely? And the reason is, we're going to go back to our previous slide here. So you see, in this example, the dividend yield is 5%. When the company reduces the dividend, it goes down to 0.4. And if the company eliminates it, the dividend yield goes to 0. Now, when the dividend yield gets reduced from 5% to 0.4% to 0, investors do not want to take that risk, especially when the dividend yield is 0. Why would they invest in a company where the return on their investment while they hold on to the shares is going to be 0%? You can put that money in a term deposit and make 2%, 2.5%. Even in a bond, you're going to make a little bit of a percentage there. Even in a savings account, even though it's 0.01%, still higher than 0. So what happens here is investors will start selling off their shares, or new investors will not be interested in investing in the company. And so when investors are not interested in a company, the demand for those shares drops. And as the demand for those shares drop, the share price also drops. And we see this over and over again. Anytime a company reduces a dividend or cuts the dividend completely, the share price drops. So these are the two big impacts that you're going to see. So we already just showed you this one. A dividend reduction will cause the stock price to drop, and a dividend reduction will also reduce your dividend yield. So as dividend investors, is there an early warning signal that can tell us that a dividend cut or a reduction is coming? So that's what we're going to look at next. We're going to look for an early warning sign, because that would be nice. If you could get an early warning sign, then you can make better decisions. And decide if you want to invest in the company or decide what to do with your shares. So the early warning sign is the payout ratio. And that's the annual dividend divided by the earnings per share. The earnings is the profits, how much money a company is making. So I'm going to give you two real life examples here. We're going to look at the beverages industry. So we're going to look at two companies in here. The first one is Molson Coors, and their competitor is Constellation Brands. So they're in the same industry. Let's take a look at the payout ratio. So the first one is Molson Coors, and you can go to any website that gives you stock price information or stock quotes. Here I'm going to use Yahoo Finance, so we can see the stock price for Molson Coors is here. What we're interested in here is the annual dividend, and you can see it's $1.52 on the screen. You can see it right there. Then we look at the earnings per share, right? How much profit is the company making per share? How much money are they making? So the earnings per share is $3.36. So if we take $1.52 divided by 336, $3.36, we express it as a percentage, you can see it's 45%. So what does that mean? It means that the company is paying out 45% of what it made back to the shareholders. So the company earned $3.36, but it's paying back to the shareholders $1.52. What do they do with the rest of the money? They reinvest it back into the business to grow the business. So this is a healthy payout ratio. This means the company can increase their dividend, maybe $1.55, $1.60, $1.62. They have room here to increase the dividend because there's enough earnings there to support a dividend increase, because the payout ratio is only 45%, which is good. Now we're going to take a look at Constellation Brands. We're going to do the same thing. Let's take a look at the dividend. It's $3.20. Let's take a look at the earnings. It is 42 cents. So now if we take the dividend, $3.20, divided by the earnings, 42 cents, we can see that the payout ratio is a staggering 762%. So you might be thinking to yourself, the company only made 42 cents a share. How can they pay $3.20 a share dividend? And what happens here, most likely, is companies will borrow money from someplace else to pay the shareholders. So this is not good news. When you look at this and the payout ratio is so high, this means that the company may have to reduce its dividend. Or they have to increase their earnings. And in this example, the earnings have to be much higher than 42 cents. It's got to be higher than $3.20. Otherwise, the company is still going to have to borrow money from someplace else to pay the shareholders. And so that's not sustainable, and they can't do that for very long. So there is a risk here that the dividend might get cut. So if we compare side by side the payout ratio for both of these companies, we can have a high degree of confidence that Molson Coors will continue to pay the dividend and hopefully increase it in the future. Whereas Constellation Brands, there's a risk here that the dividend might get reduced or eliminated. And as dividend investors, we don't want to take that risk. And I don't want you to take that risk. So when we look at the payout ratio, generally we look for 75% or less. In this case, Constellation Brands is at 762%. It is way too high. And so at that point, we would skip it, move on to another company, because that is an early warning sign that the dividend is going to be affected negatively. If you miss the payout ratio, here's another sign of bad news. So again, we go back to Six Flags. In 2020, the dividend was reduced to 25 cents a share before they completely cut it the following year. So that is another red flag there, or a yellow flag, that something is going on with the dividend. So those are the two early warning signs. The dividend reduction or the very high payout ratio are going to be your two early warning signs that you need to watch out for before you invest in any dividend stock. Now, if you miss those early warning signs completely, what do you do after a dividend is either reduced or eliminated? So let's take a look at that right now. Now, most investors, and I know a lot of dividend investors, will automatically sell their holdings. If a company eliminates the dividend, they will just sell all of their shares in that company. And you could do that if you want to. That might be a good approach. Let's take a look. We're going to spend a couple of minutes discussing what approach you should take. So we're going to look at that. What happens if a company eliminates the dividend and you're still holding on to the stocks? What should you do? And the other thing is, what if the dividend is reduced, but not eliminated? So the company is still paying you a dividend, just not as much. So you're still making some money. What do? Do you sell the shares or do you just hang on to it because you still are getting some dividends? So let's take a look at TC Energy. This is a real life example, and this will help us answer those two questions of what to do with our stocks. So TC Energy, take a look at the dividend in 1990, it was 69 cents a share. In 91, they increased it to 73 cents a share. And you can see on the screen the dividend has gone up every single year till 1997. In 1998, the dividend remains the same. So that's a yellow flag. The company didn't increase it, they just kept it the same. So that's a yellow flag where we are a little concerned as to what's going on here. How come they didn't increase the dividend? Then in 99, they reduced the dividend to $1.12. Another yellow flag. Then in 2000, they reduced the dividend again to 80 cents. Okay. And then in 2001, the dividend goes up to 90 cents. 2002, the dividend goes up to $1. So just to summarize, in 1998, the dividend was not increased. 1999, the dividend was reduced. And in 2000, the dividend was reduced. But ever since then, after the year 2000, the company has increased its dividend every single year for 22 years consecutively. So I personally bought 185 shares in TC Energy back in 2000. And I looked at the dividend history. I saw that the dividend was cut twice. But I applied the 12 rules, and we're going to get to the 12 rules in a couple of minutes here. The company passed the 12 rules. The company was getting in better financial shape. Now, there was still risk, right? Buying the shares in the year 2000 because they could have reduced the dividend again as well, but they didn't. And in fact, the company has paid me more in dividends since I've owned it than my initial investment. I've received over $8,000 in dividends, and my initial investment in this company was $2,479. So this is a bit of a success story following two yellow flags where they had dividend cuts. So here's my suggestion to you, right? At the end of the day, you have to make that decision. Our job here is to educate you to make the right decisions when it comes to dividend investing. So if the dividend is eliminated, you may want to do what most dividend investors do, is to sell their holdings immediately. Because when the dividend is eliminated, your dividend yield is zero. You're not getting paid for holding on to the shares. You may want to sell. Now, you may want to consider how much you paid for the shares, what they're worth today. Do you think the stock price is going to come back up again? Do you want to hang on to it for that long? And what are the alternatives? If you're earning a 0% dividend yield, even though the share price has dropped, you may want to put that money into something else that's going to pay you 4.5%, 5% yield, right? There's an opportunity cost for not doing anything. So if a dividend is eliminated, you may want to sell your holdings, right? That's one of the suggestions. And if the dividend is reduced, again, majority of dividend investors will just sell immediately. Or, like I showed you in the case of TC Energy, you may want to wait. And what I suggest there is to wait for the dust to settle. We'll see a dividend reduction, so that's one yellow flag. If we see another reduction, that's two yellow flags, then you may want to strongly consider selling your holdings, right? Because now your dividend yield is coming down. So some dividend investors will wait for 2 cuts or 3 cuts and then they sell, right? So they're going to wait for the dust to settle and see what happens. The first dividend cut doesn't mean you should sell automatically. Wait for the second one. If it happens again, fine. Hopefully it doesn't happen again and the company can recover. In the case of TC Energy, the company has recovered and now has had a 22-year dividend streak of increasing dividends year after year. So this is not an exact science, as you can tell. Different investors are going to do different things, and it's going to depend on when did you buy the shares, how long have you owned the shares, how many dividends have you received over the years, have you already recovered your capital investment, how much did you pay for the shares, what are they worth today, how long are you willing to wait, what does the rest of your dividend portfolio look like. Hopefully the rest of your portfolio is doing okay and you're generating more income than you did in the year before. And so one company reducing it is not going to be tragic to your stock portfolio. So those are the suggestions that I have for you. So given all of this, how do you have any confidence as a dividend investor? When it comes to dividends, there's no guarantees. Companies are under no legal obligation to pay you a dividend. They can reduce the dividend anytime they want, and they can cut the dividend anytime they want. So as a dividend investor, how do you have any confidence to invest in dividend stocks? So for that, we look to the past. Take a look at some of the companies on this list. You'll notice Black & Decker, Colgate-Palmolive, Johnson & Johnson, Coca-Cola, Procter & Gamble. These companies, a lot of these companies have been paying dividends since the 1800s. Even more important is the column in the middle, consecutive years of dividend increases. So you can see Johnson & Johnson has had 59 years of consecutively increasing their dividend. Think about how many market crashes we've had in the last 59 years, how many recessions we've had in the last 59 years, but yet companies like these have continued to increase their dividend year after year after year. So sure, there's no guarantees when it comes to dividends, no guarantees when it comes to investing. I don't know what's going to happen next week, next month, next year in the stock market. Are we going to have a crash or are things going to go up? Nobody knows. But when we look at a list like this, we can have a high degree of confidence that companies like these will at least continue to pay us a dividend in the future and hopefully increase the dividend in the future. So this is just a small subset list of companies. I mean, there's companies out there that have been consecutively increasing dividends for 25, 30, 35, 40, 50, 65 years. And we have a similar situation in Canada. We have companies that have been paying dividends since the 1800s. If we take a look at Canadian Utilities, at the top of the list, they have consecutively increased their dividend for more than 50 years. So this should give you some confidence that companies like these will continue to pay us a dividend. So a well-diversified stock portfolio is going to ensure that you can withstand one or two dividend cuts or dividend reductions that may happen over your investing career. So you want to have a resilient portfolio. So our approach here is to invest in quality dividend stocks. So not just any dividend stock, but a quality stock when they're priced low, when they're undervalued. Not when they're overvalued, but when they're undervalued. So how do you know when you're looking at a stock if it's a quality stock? And how do you know when it's priced low? So for that, I've created what I call the 12 rules of simply investing. You can see them up on the screen here. For those of you on the audio version, I'm going to list out the 12 rules in just a few seconds here. This is your checklist. You want to make sure before you invest in any company that it passes all of the 12 rules and not just some of the rules. The rules here, I've been a dividend investor for over 22 years. The rules here are designed to minimize your risk, preserve your capital, and help you maximize your growth. So we want to make sure this is your checklist. A company passes all the 12 rules before you invest in it. Rule number 1, do you understand how a company is making money? If you don't, skip it. Move on to another company. Rule number 2, 20 years from now, will people still be using its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? And that's where we look at the payout ratio. We want to make sure the payout ratio is 75% or less. If it's greater than that, company fails rule number 7, we skip it, move on to something else. Remember, we have to pass all of the 12 rules before we invest in a company. Rule number 8, is the debt less than 70%? Rule number 9, avoid companies with a recent dividend cut. So here, we're already taking advantage of the fact that we've looked at the previous year. If the dividend was recently cut, company fails rule number 9. Skip it, move on to another company. Wait another year and let's see what they do with the dividend. Do they come back and increase it or not? So this gives us a little bit of a buffer or a time that we're going to wait. We're not going to immediately jump into any dividend company. Rule number 10, does it buy back its own shares? Rule number 11, is the company priced low? We're going to look at the PE ratio, the PB ratio, and we're going to compare the current yield to its average dividend yield. And so that's going to tell us if a company is undervalued. And rule number 12, keep your emotions out of investing. For anybody who's interested in the Simply Investing online course, I cover all of the 12 rules with real life examples. I also provide you with a Google spreadsheet that you can use to fill in all the values yourself and apply the 12 rules to any stock anywhere in the world. And then you can see for yourself, is this something you want to invest in, or is this something you're going to skip for now? If you want to go faster, I've built the Simply Investing platform. It's a web app. We automatically apply the rules to over 8,000 companies in the US and in Canada every single day. We show you all the companies, all the rules that they pass. We show you the failures. You want to, again, focus on companies that pass all the rules. Those are the ones you want to consider for investing. And then we show you companies that are overvalued. And those are the ones you should avoid. And so the platform does that for you every single day. Just log in. You see the list of companies right away. It is the most comprehensive stock dividend research platform there is. I basically built the platform. It took 2 years to build. I built a platform that I wish I had when I started doing this over 22 years ago. So that's going to make it a lot easier for you to evaluate which companies to look for. And so for listeners of this podcast, take a look at this coupon code. It's up on the screen. The coupon code is SAVE10. 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 So this coupon code is going to give you 10% off of any product and service on our website at simplyinvesting.com. You get 10% off the course, you get 10% off the platform, and the platform is a subscription. You can pay for every month or every year. As long as you continue to remain a member, the automatic renewal will automatically apply the 10% discount every single time. So you can save quite a bit of money that way. So for more information, take a look at our website, simplyinvesting.com. If you like this podcast, be sure to click on the subscribe button. Click on the like button as well. We have a new episode out every week, and I will see you next time.